Good morning everyone and welcome to the Myerson Annual Property Update. Thank you all for joining us. I'm Joanne Perrett, the head of the real estate team here at Myerson, and today is Wednesday the 2nd of November 2022. It's fair to say that since our annual update this time last year, we've continued to be in uncharted waters, or even unprecedented times, to use the phrase we hoped we were going to leave behind this year. We knew that COVID, whilst it's become less of a pressure on the day-to-day and life has largely returned to normal, we knew that it would still be here through 2022 and that it would continue to have a direct impact on the economic climate. We also anticipated that Brexit would continue to have an impact on supplies, labour and trade, and this has clearly been the case. But what we didn't anticipate was the war in Ukraine and the energy and cost of living crises which have arisen because of this and because of all of the other issues I've just mentioned. In early September, the death of the Queen was a very sad event which impacted the country at all levels. Finally, whilst we might have expected some political uncertainty in the country during the year, the turmoil in the government throughout the year and then the devastating effects on the markets of the mini-budget and the subsequent hike in interest rates, and then finally the resignation of Liz Truss and appointment of Rishi Sunak as the third Prime Minister of 2022 have all conspired to make this a year of incredible uncertainty. There is a general feeling that the new Prime Minister needs to deliver stability and clarity, both politically and economically. Mr Sunak's first speech in his new role mentioned levelling up, and he has reappointed Michael Gove as Levelling Up Secretary. So the property sector will watch and wait to see if levelling up and all that this promises will now rise to the top of the agenda. It seems very likely, though, that uncertainty will persist for some months to come, and that 2023 is likely to be a bumpy year for the real estate sector as a result. The Estates Gazette has been a bit full of doom and gloom recently. They declared that the UK is officially the most distressed market in Europe. The feeling from a lot of our clients and contacts is that the industry has paused over the past couple of months and is waiting to see what will happen. Immediately following the mini-budget, we did see a number of transactions stall or have funding deals significantly changed and even pulled at the very last moment as the market and lenders reacted. The fallout from this will continue for some time as the markets try to restabilise following Jeremy Hunt's appointment as Chancellor, the reversal of the majority of the provisions of the mini-budget, and then the recent appointment of the new Prime Minister. It's not bad news for the whole of the industry though. A lot of cash has built up during COVID, which buyers haven't been able to or perhaps they haven't wanted to spend due to increasing prices and a lack of stock in the market. So a rebalancing of the market, whilst painful in the short term, will hopefully lead to a more sustainable market for the future. So I'm pleased today to introduce you to two new partners who've joined Myerson in the last 12 months. Leah Rossiter is a partner in the real estate team and is a very experienced lawyer who joined us earlier in the year from the Manchester office of a national firm. Richard Wolfe has also joined us to head up our new insolvency and restructuring team. Richard has 25 years of experience in the insolvency sector, having headed up the team at JMW for over a decade before joining Pennoni Corporate. Richard's arrival means that we can offer our clients expert advice if the downturn in the economy leads to them needing insolvency and restructuring advice, either for themselves or in respect of their tenants, which unfortunately appears inevitable for some individuals and companies over the coming months. Richard's going to talk to us today about property insolvency and how he sees that panning out over the next year or two. On the construction side, we will be hearing from our Head of Construction, Neil Armstrong, on the effect of the economy on the construction sector. You'll no doubt have seen firsthand or in the press over the past few months that there have been an increasing number of construction insolvencies, due in many cases to the pressure on materials and labour brought about by both Brexit and COVID. At times of difficulty for a sector, it inevitably means that people will be looking more closely at their projects, and Neil will be talking about what this means for the adjudication process. Neil will also be discussing the Building Safety Act, which is being brought in to provide additional protection for leaseholders from the costs of making good building safety defects and to overhaul the existing regulations. The ESG agenda continues to climb in importance for the real estate sector and business as a whole, it can definitely no longer be ignored by anyone who's involved in the property sector. Leo will be taking us through the current position in terms of the market view and what property owners and occupiers need to be thinking about. In this context, Sidra Ashraf, who's an associate in our real estate team, she'll then take us through the upcoming changes to the MEES Regulations, which will take effect in April next year. Sidra will then move on to tell us about another area of regulation which those involved in the property sector need to be aware of, where overseas entities are involved in the ownership of property. First up though, I'm going to hand over to Laura Pyle, our Head of Real Estate Litigation. COVID rent arrears have obviously continued to be a big factor for landlords over the last couple of years, and the coronavirus arbitration scheme has now come to an end. Laura's going to take us through the current position for landlords and tenants and also touch on some of the other case law which has affected the property sector over the past 12 months. Over to you, Laura.
So thank you, Jo, and good morning, everybody. This morning, I'm going to update you on the Commercial Rent Coronavirus Act 2022 and the current position regarding the arbitration scheme in the future, current enforcement options for rent arrears and recent case law. So firstly, let's have a look at the arbitration scheme. So you'll all no doubt recall that the Commercial Rent Coronavirus Act 2022, which came into force on the 24th of March 2022, introduced a binding arbitration scheme to deal with commercial rent arrears that accrued during the pandemic. It does appear from our experience that very few referrals have actually been made to the arbitration scheme, and a recent report by the Property Litigation Association stated that following a survey of the arbitration bodies in England and Wales, 95% of those polled had not made any referral under the Act. Nigel Ditchburn, chair of the PLA, recently commented that property owners may simply prefer to pursue a negotiated commercial solution, or may be waiting to see if the tenant misses the deadline for making a referral, in which case the property owner can enforce the rent arrears in the usual way. And this has certainly been our experience of this. The arbitration scheme allowed for referrals to be made for a period of 6 months from the date the Act came into force. This deadline has now passed, and therefore, if a referral had not been made in time, then unless an agreement is reached between the parties, the arrears are now payable in full, and the landlord can take enforcement action for non-payment of those arrears. Given the deadline to refer matters has now passed, I thought it would be useful to briefly run through the options now available to landlords to recover any outstanding arrears of rent, as it has been some time since the landlord's options have not been restricted in any way. So firstly, CRA, or the Commercial Rent Arrears Recovery Scheme, is one method of recovering rent arrears relating to a commercial property. CRA applies where the tenancy is in writing, so if the tenancy is not in writing, CRA cannot be used. CRA is only exercisable against arrears of principal rent. Therefore, if any of the arrears relate to service charges, insurance rent, or other sums due under the lease, even if the sums are reserved as rent, CRA cannot be used to recover them. 7 days net rent must be unpaid for a landlord to be able to use this method of enforcement. A greater amount was needed during the pandemic, but it's important to note it has now been reduced back to 7 days. To exercise CRA, an enforcement agent needs to be instructed. They give notice to the tenant and can then go to the property and seize goods on the premises. These goods can then be sold to satisfy the arrears. It is a relatively quick process, and sometimes the embarrassment of the enforcement agent attending the premises can elicit a payment. Another option is to issue court proceedings. The threat of proceedings itself will be less likely to prompt payment. However, the consequences of a judgment, once spelt out to the tenant, might very well prompt a tenant to make payment, particularly if the impact of a judgment against it would trigger credit defaults, which is typically the case, or if the judgment has a ripple effect on the tenant's ability to secure finance, and more often than not, the big pressure point, lines of credit from suppliers being terminated. Landlords often shy away from this option unless the tenant has assets over which a charging order could be obtained, or it has goods that could be controlled using writs and warrants of control. But often reminding a tenant of the effect of a judgment is enough to encourage uncooperative tenants to engage in negotiations. Now, where the tenant has failed to pay rent or other sums due under the lease, then ordinarily the landlord may wish to consider commencing insolvency proceedings. Where there is no dispute as to the amount of the debt, the landlord can serve a statutory demand on the tenant. If the sum due remains unpaid after 21 days, and it is £5,000 or more in relation to a tenant who is an individual, or more than £750 for a company, then this may be deemed evidence of the tenant's inability to pay a debt and gives grounds to present a winding up petition. Another option is the rent deposit deed. So the landlord may be able to draw down from a rent deposit to recover the arrears or other sums due under the lease. However, the landlord will need to check the terms of the deed carefully to ensure it covers the items the landlord is wanting to recover. Depending upon the terms of the deed, the landlord may need to give the tenant notice before they use the deposit monies. There may also be provision requesting the tenant tops up the deposit. The landlord may also be able to recover rent arrears and other sums due under the lease from the guarantors or former tenants. Now, the landlord will need to ascertain whether the lease is an old lease or a new lease. An old lease is a lease entered into before 1st of January 1996. And in the case of an old tenancy, the landlord can look to pursue the original tenant and sometimes the original guarantor for the current tenant's arrears. In the case of new tenancies, outgoing tenants and guarantors will be released on an assignment of the lease, but they can still be pursued if they entered into an authorised guarantee agreement, or AGA. To recover the sums due from former tenants or guarantors, a Section 17 notice will need to be served on them. Now, it should be noted that there is a 6-month limitation period on serving those notices. Therefore, the Section 17 notice must be served within 6 months of the sum falling due for payment, failing which the right to recover the debt will be lost and the landlord will only be able to recover the debt from the existing tenant. Multiple Section 17 notices will need to be served because, for example, if sums fall due on the June quarter date and then on the September quarter date, a Section 17 notice will need to be served for each of those sums. Now, this remedy is often overlooked but can be very useful and gives the landlord more options to recover the monies that are due to them. So forfeiture is another option available to a landlord. So forfeiture, or the landlord's right to determine a lease where the tenant is in breach of its obligations under the lease, is an option available to the landlord if they want the property back. So in summary, there are a number of options available to a landlord to recover outstanding rent arrears, and please don't hesitate to get in contact with us if you require any assistance in relation to this. So let's go and have a look at some recent case law. So there have been some recent cases relating to pandemic arrears, and the first case is Oceanville Limited versus Nuffield Health Wellbeing Limited and another. In this case, the landlord was seeking a summary judgment against the former tenant of premises and the guarantor in relation to unpaid rent. The facts are that Nuffield Health had a 25-year lease of a gym. Its obligations were guaranteed by its parent company. The lease was then assigned to Virgin Active Limited, and under the terms of the licence to assign, Virgin Active Limited's obligations were guaranteed by Nuffield Health under an authorised guarantee agreement. Rent was unpaid because the High Court had approved a restructuring plan for Virgin Active, which comprised the arrears of rent. As a result of this, the landlord sought to recover the arrears from Nuffield Health under the authorised guarantee agreement and/or their guarantor. The claim was defended on the basis that the restructuring plan varied the lease so that the rent ceased to be payable. The Deputy Judge in the High Court said the restructuring plan operated as a statutory release or discharge for the tenant and was not a variation of the lease itself. The judge held that a restructuring plan leaves unaffected the rights of the landlord against third-party guarantors. As between them, the lease remains valid and subsisting, therefore summary judgment was given. Now, the takeaway point from this case is that landlords are at a greater risk of losing their rights of enforcement where a restructuring plan is proposed. However, unless guarantors are parties to the plan, the landlord's rights against the guarantors are unaffected. Now, the second case is the case of Bank of New York Mellon International Limited versus Cine UK Limited and London Trocadero 2015 LLP versus Picture House Cinemas Limited. In this case, the Court of Appeal rejected arguments made by tenants seeking to avoid liability for rents that fell due during the pandemic. The tenants in these cases put forward three arguments. Firstly, that the rent suspension clause should have operated to suspend rents when there was an enforced closure of premises caused by the pandemic. Secondly, that the government restrictions imposed for periods during the pandemic caused a failure of basis, which relieved the tenants of their obligations to rent. And thirdly, that a term should be implied into the leases to relieve the tenants of the obligations to pay rent whilst the premises could not lawfully be used for their purposes as a cinema. In the Bristol tenants' lease, the rent suspension clause was drafted in a traditional form where it suspended rent where the property was destroyed or damaged by any of the insured risks, so as to render it unfit for occupational use. The Court of Appeal confirmed that the clause operated only where there had been physical damage or destruction of premises. In relation to implying terms into leases, the terms sought included a term to extend the rent suspension clause to cases of non-physical damage where, at the tenant's expense, the landlord insured against loss of rent arising out of those circumstances, a term to suspend rent if the permitted use under the lease became illegal, and a term limiting the payment of rent to periods where the premises could be used as a cinema with levels of attendance commensurate with what the parties would have anticipated at the time that the lease was entered into. The Court of Appeal was of the view that none of the terms sought by the tenants would satisfy the business efficacy test required to imply the terms. The business efficacy test is only satisfied if, without the term, the contract would lack commercial or practical coherence. And in these cases, there was nothing unworkable or incoherent about the allocation of risk, and implying the terms would be inconsistent with the express allocation of risk agreed to by the parties. Finally, the Court of Appeal considered failure of basis. The tenants were seeking the remedy of restitution under the law on unjust enrichment, based on the fact that the premises had been demised for use as a cinema, but the letting had failed for several parts of the term. The tenants claimed unjust enrichment for rents payable for periods during which it was unlawful for them to use their premises for the permitted use. The question to be answered was, how could the landlord be unjustly enriched when they had a legal right to receive the rents? Now, the Court of Appeal said that there is an obligation to pay rent for the demise for the term, and on a true construction, the rent was only suspended where the cessor of rent clauses applied, i.e., where there is physical damage to the premises, meaning it is unfit for occupation, that there is no gap in the lease that requires filling by a claim in unjust enrichment. The Court of Appeal held that the contention that the basis for the obligation to pay rent is that the premises can be used lawfully as a cinema is inconsistent with the express terms of the lease and the allocation of risk between the parties. Therefore, the tenants were unsuccessful. Now, that's the end of my update, so please don't hesitate to contact me if you have any queries, if I can be of any assistance at all. But I'll now hand you over to Neil Armstrong, a partner and head of the construction team, who's going to talk about the Building Safety Act and adjudication. Thank you.
Thanks, Laura. Everyone knows about the Building Safety Act, which came into force on the 28th of April 2022. The Act implements many of Dame Judith Hackett's recommendations in response to the Grenfell Tower fire in 2017. There have been a number of draft pieces of secondary legislation published, which are also expected to be brought into force in due course, but there remains a lot of further regulations which are still anticipated. It's also anticipated that all of this will be brought into force within the next 12 months. For those who have read the Act, they will see that the scope of the Act is very wide. It covers things such as the introduction of the Building Safety Regulator, competency requirements, duty holders, in-occupation obligations, additional requirements such as the gateway regime for high-risk buildings, changes to landlord and tenant law for the liability for the costs of building safety measures. It relates to the remediation of defects. It includes new duties and liabilities for developers. It introduces a new homes ombudsman, and it also covers the regulation of construction projects. So as you can see, the scope of this is much too wide to be able to talk about it in the few minutes that I've got today, but I just wanted to focus on a couple of single issues, and those relate to the liability for a developer for completed schemes. Now, the Building Safety Act brings into force amendments to two things: the Defective Premises Act and extended limitation periods under both the Building Safety Act and the Defective Premises Act. So, taking claims under the Defective Premises Act first, the existing Section 1 imposes a duty on persons carrying out work for the provision of new dwellings. It requires the works to be done in a workmanlike manner using proper materials, so that as regards that work, the dwelling will be fit for habitation when completed. The duty under that is owed to the person who commissioned the dwelling and also every person who acquires an interest in the dwelling. Effectively, the claimant, which could be a purchaser or tenant, must show that the failure by the duty holder to carry out the work in a workmanlike manner or professional manner, or the failure to use proper materials, has led to a defect that means that the dwelling is not fit for habitation. Now, under the existing Act, the limitation period for those claims is 6 years from completion of the dwelling. The changes under the Building Safety Act mean that the DPA is extended. It will include work on existing buildings, because it relates to any work on a building that contains a dwelling, and that's contained in the new Section 2A. And the Act also seeks to extend the limitation period for claims relating to a dwelling under the Act. There's a longer limitation period generally for all claims, which has gone from 6 years to 15 years. And for claims arising prior to the commencement of the Act under the original Section 1, the limitation period has been extended from 6 to 30 years. In effect, the claims under Section 1 applies both prospectively going forward for 15 years and retrospectively. So claims for new dwellings under the Defective Premises Act can now be brought for a period of 30 years retrospectively. Section 2A, the Section 2A changes relating to the any dwelling only applies prospectively, so it only applies to claims from the date that the Building Safety Act came into force. I'm just going to move on now to Section 38 of the Building Act 1984. For those that know about this, this is a historic provision that was included in the Building Act in 1984, but was never brought into force. That provision creates a civil liability for a breach of building regulations, which means that people could bring a claim for a breach of that regulation, and that could be pretty much anybody that suffers damage. This also applies to all buildings, and it's not limited to just residential developments or residential buildings. It's effectively available for anyone who suffers damage. Previously, a claim for a breach of building regulations would have had to be brought for either breach of contract or in tort for negligence. But the introduction of this will mean that anybody can bring a claim for a breach as a breach of statutory duty. Now, it should be noted that this is not yet in force, but the government has said it will be brought into force. And the limitation period for claims under the Building Act 1984 will be 15 years. I'm now going to turn to the next topic, which is construction adjudication. Adjudication is a fast and relatively inexpensive means of dispute resolution. It can help to resolve interim payment disputes and keep projects moving. In the 25 years since its introduction in the 1996 Construction Act, the adjudication of construction disputes has become a successful addition to the range of dispute resolution mechanisms available for use in the construction industry in what used to be an over-adversarial litigious environment. The main objective was to improve the cash flow to fund ongoing works on construction projects. A particular concern was that disputes between supply chain members could only be resolved by litigation or arbitration, which would take time and could disrupt the entire project. Adjudication can help to solve those cash flow issues. Disputes may be referred to an adjudicator at any time, and decisions are given within tight time limits. Although they're only provisionally binding, the courts have shown a readiness to enforce them by summary judgment, leaving any continuing disagreement about the merits of the underlying dispute to be resolved later. There are around 2,000 adjudications per year, but only a fraction of them end up before the courts for enforcement, and most decisions are accepted by the parties. Some concerns have been raised about the cost of adjudicating smaller disputes, and these have been met by new low-value dispute schemes introduced by TEXA, CIC and the RICS, where adjudicators offer their services for reduced or capped fees. The most popular method for resolving construction contract disputes in the UK, though, is still adjudication. It's been in operation for over 25 years, and as a result, there's an increased familiarity with it. Over the past 2 years, the COVID crisis threw a spotlight on adjudication as a barometer of the state of the industry. Looking at the experience of the RICS is an adjudicator nominating body. There are a number of these, but the RICS is perhaps the most popular. Parties apply to the RICS for the appointment of an adjudicator, and it's appointed over 20,000 adjudicators since 1998 when the Act came into force. The RICS's experience is that just before the UK economy goes into a decline, there's usually a sudden and short-lived upturn in the numbers of adjudications. And then that's followed by an equally dramatic fall in numbers as the economic downturn kicks in properly. The COVID effect has led to a slightly different experience. Based upon figures published by the RICS at the beginning of this year, adjudication appointments made by them rose to over 120 a month, which represented a monthly increase of around 50%. This continued from the end of March 2020 until the late summer. The following decrease in numbers of adjudications was slow, but by early 21, numbers had fallen back to just below the pre-COVID levels. From the beginning of October, however, there has been a sharp upturn in applications to the RICS for appointments, signalling that adjudication numbers at the beginning of this year were again on the rise. There are no statistics from this year just yet. The RICS usually publish them early in the following year, but it's anticipated that the levels of adjudications have remained at the same, or they've increased again. This ties in with the state of the UK economy and the post-pandemic period, and the likelihood is that adjudications will have increased significantly again. Problems generally in the UK construction sector are intensifying. There's a shortage of manpower. There has been a record demand for construction products, but also increasing prices and shortages. There's been increases in fuel and energy costs, increased labour costs, higher interest rates, and also a slowdown in the wider economy. It's become very difficult for contractors to accurately value contracts. There's also always a lag between work being performed and being paid for in the construction industry. Contracts usually provide for periodic or monthly payments in arrears. Therefore, the period from carrying out the works to being paid can be as much as 90 days without taking into account late payments on the back of that. All of this is increasing the pressure on cash flow across the sector. When you compare alternatives for pursuing the recovery of payments or debts, the adjudication process is often the quickest. A party looking to pursue the recovery of outstanding sums is increasingly likely to look to adjudication where it's available, we've found. Taking into account the potential for insolvencies, speed is often key in obtaining a successful recovery. Looking at some of the statistics for construction insolvencies, Turner & Townsend reported in August that insolvencies had risen by 72% year on year in the second quarter of 2022. In 2021, 2,579 construction sector firms across England and Wales became insolvent, which amounts to 19% of all insolvencies. Therefore, it's becoming key to consider initiating adjudication proceedings before a party becomes insolvent, and that can make the difference between securing payment prior to their insolvent or ending up in the queue of unsecured creditors with a minimal prospect of a return. All of this is pointing to an increasing tendency to refer payment disputes to adjudication sooner rather than later, and as a result we think it's likely that we're going to see an increase in the number of adjudications and that continuing. Just picking up on the insolvency point now, this provides a good segue into the next speaker. Richard Wolfe is our new insolvency expert, and he's going to talk about whether we're going to see an increased level of property-related insolvencies.
Thanks, Neil. Well, it won't be lost on anyone that the UK economy is currently facing an almost unprecedented number of major challenges. These include the after effects of the COVID pandemic, the fallout from Brexit, and the consequences of the ongoing war in Ukraine, such as the energy crisis, which has both significant implications for the level of costs faced by UK businesses, as well as contributing to an increase in living costs for many UK households. That in turn means a marked reduction in the amount of discretionary spending finding its way into the UK economy across a wide range of sectors. For anyone with an interest in real estate, whether as a commercial landlord, commercial tenant, property investor, or even as a homeowner, the impact of the various factors that I have just mentioned is becoming all too tangible, and therefore gives rise to the question of the likelihood of there being a worryingly significant increase in the coming months in the numbers of formal insolvencies where property is a key element, as the country looks to be falling into the grip of an inevitable and probably overdue recession. Well, the major port of call in trying to determine the direction of travel of property-related insolvency is arguably to view it from a sector-specific perspective. So let's start then with hospitality and leisure. Well, the hospitality industry has regularly hit the headlines recently, with increased numbers of businesses having to close due to rising and unaffordable energy bills. The extent of the rise in business failure, notwithstanding government promises to provide some much-needed support over the coming months, means that more businesses are now facing the threat of insolvency as a result. The Insolvency Service has reported a massive 59% increase in corporate insolvencies in the industry over the past 12 months, mostly taking the form of creditors' voluntary liquidations, which means that company directors are now increasingly taking active steps to close the doors ahead of creditors pursuing action against them for unpaid liabilities. From the point of view of businesses that rely on healthy levels of discretionary spend, and as the cost of living crisis worsens, the number of insolvencies is likely to increase further. There was a 37% increase in corporate insolvencies from July to August this year alone, and it has been suggested that no less than 3 out of every 4 nighttime economy-related businesses, such as bars and clubs, are currently nearing insolvency. In fact, over 150 licensed premises are closing every single week, meaning that there are now almost 10% fewer licensed premises in the UK than was the case at the start of the pandemic back in March 2020. Well, a growing number of hotels, many of which have restaurants attached to them, have also faced the threat of insolvency. One example is a well-known hotel in the northeast of England, the Sea Hotel in South Shields, which recently went up for sale at £1.65 million after its owners, a property development group, went into administration last year. The business was reported to have £2 million worth of debt, and in fact the hotel had been incurring losses for the past couple of years, despite the owner's best efforts to restructure the business to capitalise on more profitable seasonal trading, such as over the summer months and at Christmas, although of course the COVID restrictions of 2020 and 2021 won't have helped with its occupancy levels. With the ability of hospitality and leisure sector businesses to revise their business models to help ensure their survival will be critical over the coming months, whatever the level of support expected from the government, which announced that it would provide ongoing and targeted support to the most vulnerable businesses in the sector. As ever, cash is king. All businesses with exposure to property-related costs, and small businesses in particular, must keep a close eye on their cash flow and make forecasts for the coming months to give themselves the best chance of surviving the tough times ahead. In particular, they should keep in regular contact with their creditors and try to agree on a way forward that both sides are happy with to avoid the risk of insolvency, such as agreeing new payment terms if the business is likely to default on payments, restructuring existing loans, or indeed renegotiating lease terms with landlords. Well, considering that last point then, the behaviour of commercial landlords is going to be key, and hospitality and leisure is not the only sector where the position of landlords will be carefully watched in the coming months. Well, another sector that's continued to struggle, facing the impact of the fallout from COVID, and particularly reduced footfall, as well as the rising cost of energy such as for lighting and heating, is the retail sector, with the Office for National Statistics producing research showing that there were 802 retail industries insolvencies covering both wholesale and retail in the second quarter of 2022, a rate unseen since the tough times of 2012. More worryingly, that constitutes a 122% increase year on year since the same period in 2021. One of the biggest issues affecting retailers, given the changing habits of consumers, the impact of the COVID pandemic, and the potentially irreversible trend towards online shopping, which has massively impacted footfall post-pandemic, is the way in which retail businesses with leased property portfolios are having to turn to formal insolvency procedures to address their significant rent liabilities, which are increasingly becoming unsustainable. Most recently, indeed within the past month or so, businesses such as Joules, the fashion retailer, with a 130-store portfolio in the UK and Ireland, and Wilko, the homeswear store business, which has already closed 15 outlets, are now looking towards the company voluntary arrangement, a formal insolvency process which, where successful, will cap the level of liabilities that a company has to pay to its creditors, including its landlord creditors. One of the more controversial aspects of the CVA, so far as companies with exposure to a significant leased property portfolio are concerned, is its ability to force commercial landlords to compromise the level of rent arrears they can recover, and worse still, going forwards, to accept reduced levels of ongoing rent where the terms of the CVA provide for a reduction or downwards restructuring of a company's rent obligations for commercial premises, and the terms of the CVA are voted through by a large enough proportion of creditors, controlling at least 75% of the vote by reference to the overall liabilities of the company. Well, the British Property Federation, which represents the views of commercial landlords, has been extremely vocal in its criticism of CVAs, and retail CVAs in particular, pointing out that almost half of CVAs that they looked at appeared to impact property owners in particular, which was getting on for double the number of cases that affected trade creditors. As well as looking at ways in which CVA proposals to creditors could be improved, such as with better standardisation of the format of the proposals so that landlord creditors can more easily see what's being proposed, it's been suggested that company directors should be required to consult with the BPF on behalf of affected property owners who are members of the organisation. Let's face it, the real problem here, though, is that of the potentially damaging effects of CVAs upon landlord creditors, including the enforced write-off of arrears, reduction of future rent income, compromising claims for dilapidations, the premature termination of leases where it may be difficult to find a replacement tenant, creating a link between the rent able to be charged by the landlord and the turnover of the tenant, and even the potential rewriting of lease terms. The question is whether all of the changes that some CVA proposals seek to impose upon landlord creditors are actually required for the purposes of enabling a retail business to restructure its debt burden in order to be able to trade out of its difficulties, or rather provide an opportunity to manipulate the level of costs for that business unfairly at the expense of its landlords. The key factor here is, of course, that of voting power and the voting mechanism within the CVA that allows for the entire body of creditors to have their say on whether the CVA is passed and is binding on all creditors. If 75% of the creditors by value vote in favour of the CVA, it is then binding on all creditors, even if most or all landlord creditors, who may be severely impacted by its implementation, vote against the proposals. The potential impact of this scenario was referenced by the judge in a recent case, the 2021 case of Lazari Properties 2 Limited versus New Look Retailers Limited, where it was commented that New Look's senior secured note holders were able to carry the CVA vote through, even though they were entirely unaffected by the CVA itself. The court pointed out the obvious imbalance in terms of fairness to the outcome for landlords, where the terms imposed on them were unduly onerous. So what then is the solution to all of this? Well, perhaps it's nothing short than a wholesale change in the way that CVAs are actually voted upon, where the landlord class of creditors maybe would need to vote to pass the CVA in a majority vote before it is then imposed on all creditors. I think that's one for the legislators perhaps to work on going forwards. Well, Before moving on to consider other insolvency processes, a passing word on the perceived impact of COVID-19 and the move to flexible working on the rented office accommodation sector. You might think that there could be some welcome news for embattled businesses facing high levels of business rates and previous steep rises in principal rent, but there doesn't seem to be any perceptible change or drop in passing rent rates to look forward to. If anything, there looks to be a move by office landlords towards exiting the market, with residential property developers keen to snap up opportunities to build more and more apartments, driven by a huge demand for city centre living, as opposed to working in city centre offices. So, with the prospect of no increase in the supply of Grade A office accommodation going forwards, the hoped-for reduction in rent looks unlikely to materialise. One trend that we are starting to see as a result of increased hardship in the UK economy is a rise in LPA or fixed charge receiverships, where lenders who secure loan liabilities over a borrower's property then take steps to realise that property when the borrower can no longer service the loan, thus providing the lender with an opportunity to enforce their fixed charge security over the borrower's property and then sell it to obtain repayment of the balance of the loan, plus potentially high levels of interest and other additional charges following the termination of the loan. Whilst the sale by receivers of a property, whether it be a commercial property or a residential property, can provide an opportunity to snap up a bargain in the open market, and although receivers do have a duty to obtain the best price reasonably available when selling, inevitably there will be a potential loss of equity value should there be a surplus left available to a borrower once the lender has recovered the loan and other repayments, contributing to a hit on the borrower's balance sheet and, all too often, depending upon the significance of the property to the business, a complete cessation of trade and a formal insolvency process, often liquidation. Well, finishing off our brief review of the UK's business landscape and the impact of formal insolvency upon property-related companies, a glance forward to the months ahead wouldn't be complete without considering the trend for company administrations, often seen as a non-terminal process where the prospect of restructuring a business and preserving a property footprint, where the business model still supports it, lends itself towards the greatest chance of salvaging a future for the business, its employees and its customers. There are definite signs of some upwards movement in the numbers of administrations across many sectors in the UK economy, not least the construction sector. That said, it may only be the next few months, with companies being hit extremely hard by the factors that I mentioned at the start of my talk, that reveal whether we are indeed in for a flurry of administrations driven by the opportunity to preserve businesses and jobs, rather than purely by the ability to make payments to some of the company's secured and preferential creditors. One positive aspect of the process now, which wasn't the case before the change in the law surrounding payment of rented administrations during the last decade, is that companies whose administrators continue to use commercial premises for the benefit of the administration have to pay rent to the property's landlord as an expense of the administration so long as the property continues to be used. This at least compensates for the fact that the statutory moratorium in administration prevents a landlord from exercising rights of forfeiture without going to court or obtaining the consent of the administrator. There's no ability to disclaim an onerous lease in administration as opposed to a liquidation, and so the need to maintain a dialogue with the landlord means that there are prospects of a better outcome for all parties concerned, including the landlord. A better outcome includes the opportunity of an agreed surrender to allow the landlord to bring in a new tenant if there is one waiting, or even the prospect of securing a replacement tenant in the form of a buyer of the business, where they can provide a decent enough tenant covenant, with the landlord often able to secure the recovery of pre-insolvency arrears of rent as part of the deal with the new tenant. Whilst it will be difficult to predict exactly where the UK economy is likely to be in, say, a couple of years' time, one thing is certain, which is that there will be a continuing increase in formal insolvencies, and especially those where real estate is a key part of a company's asset base and business model. Well, I'm now going to pass you over to Leo, who will be talking about ESG.
Thanks, Richard. ESG is becoming a fairly familiar term, but I thought it was useful just to briefly touch on the meaning of it. Firstly, environmental. In this context, essentially concerns energy, the use of energy, how much energy is wasted, and the consequences, such as carbon emissions and climate change. Every business and indeed every individual affects and is affected by the environment. Social, how does a business interact with society as a whole? How does it deal with diversity, inclusion, its reputation? How does a business sit within its local and wider community? And finally, governance. How does a business comply with the law, the numerous regulations and legislation? What are its internal procedures and policies to do so? Clearly, these distinct elements overlap with each other, and ESG is becoming something of an umbrella acronym to encompass the demands of a changing world. Dealing with ESG concerns is becoming increasingly important and a vital component of most, if not all, businesses. Public awareness of the impact and potential impact of organisations on the environment and society is developing rapidly. Both consumers and investors are placing ever more significance on a company's ESG position, and, as such, a strong ESG proposition can safeguard a company's long-term success. However, it's not always clear what ESG strategy to adopt and/or how to implement any such strategy. While the broad concepts are largely understood and accepted, it can be difficult to make considered decisions based on the current speculative narrative, particularly as that narrative continues to evolve. One of the key trends at the moment is the increasing importance of ESG credentials in the real estate sector. The principal concern being the need to reach net zero. At governmental, corporate and individual levels, there is a push towards achieving net zero targets, which in turn has led to an increase in investment and regulation. There is also a trend to improving the ways in which a building delivers an attractive workspace, one that seeks to enhance the well-being of its users. The net zero agenda has been around for a while, but now plays a key role in investor demands on any new development or purchase. It also provides serious challenges in respect of existing older properties that risk being left on the scrap heap. The government has set a net zero target for 2050, and while that's clearly many years away, there is a lot to be done to achieve that. Demand for change is principally being driven by ESG pledges being made by corporate occupiers and institutional investors. In addition, there are increasing demands, of course, from the regulators. Energy efficiency, sustainability and the like are no longer added benefits but standard requirements. This particularly presents challenges for existing older properties. There is a real risk of a new class of stranded or distressed assets being created. The further advanced a business is in terms of compliance and future-proofing, the less likely it is to be the target of interventions. The extent of regulations and the risk of interventions and the resulting impact on profits can vary from sector to sector, but a clean company can drastically reduce its exposure to the risks and associated costs of regulation. Making the necessary changes to a building will clearly have a cost, particularly the older the building is. That leads to the question of who will pay. With an investment property, will the landlord or the tenant pick up the bill? A review of existing documentation may be required to establish whether the position may be covered by, for example, general service charge provisions. But if not, there may need to be some negotiation between landlord and tenant to establish or agree where the liability lies. Going forwards, it is important for new arrangements, new leases, to address the liability for ongoing or future changes to meet the demands of new regulations and new legislation. Making changes to buildings are needed to maintain or improve value, make them more attractive to investors and occupiers, as well as satisfying the requirements of funders. While a strong ESG stance may not in itself lead directly to opportunities, a weak position may close doors. for example, losing occupiers through poor sustainability practices. There is a willingness to pay a premium for green space, and an uneven playing field could prove to be the deciding factor. While initial costs will be incurred in making changes, executing ESG effectively can provide significant help in mitigating rising operating expenses. Sustainability is in effect aimed at reducing waste and increasing efficiency. Occupiers, particularly larger public companies, are already declaring their ESG promises, and this in turn will place pressure on their landlords and perhaps change the nature of the relationship as they each look to achieve their ESG objectives. If a landlord is unable or unwilling to assist their tenants in achieving those net zero targets, then those tenants will look for buildings and landlords that will do so. Potential new occupiers will be wary of taking space in buildings where they fear the landlords will need to carry out substantial and expensive works, adding to the service charge exposure in order to improve a property's efficiency. There is also a demand for a change in the way buildings work. Social initiatives and benefits will add value. The well-being of the individuals using the property needs to be considered and will be an important factor in attracting new occupiers. While we are currently experiencing particular economic concerns, lenders have shown a keen interest in energy-efficient properties and are likely to increasingly favour such buildings. Funding decisions are and will continue to be influenced by ESG considerations. With the commitment to ESG and higher energy prices, it is in the interests of all to reduce the carbon footprint of a property, whether owned or occupied. Assets, particularly property, benefit from a high level of ESG compliance in terms of cleanliness, efficiency and sustainability, at least from an environmental point of view. Also, changes may be required from a social perspective, not least to allow for inclusivity and meet legal requirements. Careful consideration should be given to the repurposing or converting of assets, in part or whole, such as electric car chargers, bike storage, more efficient plant and machinery, areas for childcare and so on. Buildings that are left behind run the risk of being part of a new type of distressed asset and will see its value plummet. While initial outlay may be expensive, with increasing regulations, employee, customer and investor demands and expectations, waiting may be the most expensive option of all. It is becoming increasingly important and advisable to not just change to comply, but also change to future-proof. I'm now going to pass you over to Sidra, who's going to talk about the MEES Regulations. Thank you.
Thanks, Leo. The changes to the MEES regulations are only a few months away, and some commercial property landlords may need to take steps to comply with them. The current MEES regulations make it unlawful for a landlord to grant a new tenancy or to extend or renew an existing tenancy of certain property having an EPC rating of grade F or G unless all the relevant energy efficiency improvements for the property have been made or an exemption applies. From the 1st of April 2023, the scope of MEES will extend to existing tenancies of most commercial property and will restrict a landlord's ability to continue to let property with a grade F or G rating. This means that landlords who were previously relying on the exemption for existing tenancies will now need to actively take steps to bring their properties up to an acceptable standard of an EPC rating of grade E or above. The relationship between commercial landlords and tenants is likely to be impacted by the changes to the MEES regulations. Tenants will need to cooperate with landlords to provide access to properties which require energy efficiency improvement works in order for them to continue to be lawfully let. Improvement works during the term of the tenant's lease could prove disruptive to the tenant's business, especially if further, more stringent changes are implemented to the MEES regulations in light of the proposed government target of EPC B by the 1st of April 2030. Landlords will also need to consider how to fund the improvement works and may seek to pass back the costs to tenants through specific lease provisions going forwards. Moving now to the new Register of Overseas Entities. The Economic Crime Transparency Enforcement Act 2022 requires overseas entities that own or acquire property in the UK to register with Companies House. The Register of Overseas Entities, or ROE, was launched on the 1st of August 2022. Overseas entities that want to buy, sell, transfer or charge property or land in the UK must register with Companies House and declare who their registrable beneficial owners or managing officers are by the 31st of January 2023. More specifically, a person is a registrable beneficial owner if they are a beneficial owner and they are not exempt from registration on the register, which is similar to the PSC regime. A person is considered a beneficial owner of an overseas entity if they hold directly or indirectly more than 25% of the voting rights in an overseas entity, have the right to appoint or remove a majority of the directors, or have the right to exercise or actually exercise significant influence or control over an overseas entity. Any legal entities that are beneficial owners that are not exempt and are subject to their own disclosure requirements are registrable beneficial owners, which is the case, for example, when they have voting rights, voting shares admitted to trading on a regulated market, are listed on the register, or are governed by the law of a country outside the UK and provide trust services if the provision of trust services is regulated in that country by a supervisory authority. So, what must the application to Companies House include? The application must include one of the following statements: that the overseas entity has identified any registrable beneficial owners and provided the required information, or the overseas entity has no reasonable cause to believe that it has any registrable beneficial owners, or alternatively, the overseas entity has reasonable cause to believe that it has registrable beneficial owners but cannot provide the necessary information. What happens when the overseas entity acquires property in the UK? If an overseas entity is not registered in the ROE when it makes an application to register a qualifying registrable deed, the land registry application will be rejected. Failure to register an acquisition of property or a lease at the land registry means that the acquisition does not take effect in law. It is important to note that the entity and its officers will commit a criminal offence if the entity delivers a qualifying registrable deed to a third party without being registered in the ROE. The third party purchaser, tenant or lender cannot register the deed in their favour without evidence that the overseas entity which owns the property is registered in the ROE, or the disposal falls into one of a limited number of exemptions. In addition to registration, there is also an ongoing duty to update. Once registered, an overseas entity is required to file annual updates and confirm to Companies House whether the information held is correct or whether there have been any changes to the beneficial ownership. The penalties for non-compliance can be severe, potentially leading to a criminal offence, and failure to register or comply with the annual update requirements will prevent the completion of a property transaction as mentioned earlier. It is therefore important that all affected overseas entities comply with these new requirements. I'll now pass back to Jo for her closing comments.
Thank you, Sidra. So that brings our webinar to an end for this morning. I do hope you've enjoyed it. If you have any questions at all, or you'd like to talk to any of the team about something you might need help with, please don't hesitate to get in touch with us at the details coming up on your screen. The webinar will be saved to our YouTube channel and you will be able to watch it again at your leisure. Thank you all again and have a good day.